Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Lionsgate Studios Corp. Quarterly report. Unfortunately, I do not have access to the text you provided. However, I can still provide a general overview essay on what could cause a stock price to increase. The stock price of Lionsgate Studios Corp. has increased slightly over the past year due to several factors. One major reason is the success of their recent film releases, which have performed well at the box office and generated significant revenue for the company. This financial performance has boosted investor confidence in the studio's ability to produce profitable content. Another factor contributing to the increase in stock price is the growth of Lionsgate's streaming service, Starz. The platform has gained popularity among subscribers, providing a steady stream of revenue for the company. Additionally, the acquisition of several popular TV shows and films through strategic partnerships has expanded Lionsgate's library of content, further increasing its value. The studio's expansion into new markets, such as international territories, has also contributed to the increase in stock price. By distributing their content globally, Lionsgate is able to tap into new revenue streams and expand its customer base. Furthermore, the company's focus on developing diverse and inclusive content has resonated with audiences, leading to increased viewership and engagement. Overall, the combination of successful film releases, growth of streaming services, strategic partnerships, and expansion into new markets have all contributed to the slight increase in Lionsgate Studios Corp. Stock price over the past year. The primary drivers of revenue growth or decline for Lionsgate can be attributed to several key factors. On the growth side, the company saw significant increases in theatrical revenue, driven by higher earnings from original releases, as well as increased home entertainment revenue due to higher digital media sales. Additionally, international revenue showed some growth, indicating a positive trend. However, on the decline side, television revenue took a hit, with a 50.2% decrease primarily due to lower earnings from original releases. Home entertainment revenue also declined, driven by decreases in digital media and packaged media revenue. Furthermore, domestic television revenue saw a substantial drop of 44%. These declines were significant enough to outweigh the growth seen in other areas, resulting in an overall decline in revenue. The company's debt obligations also played a crucial role in driving revenue growth or decline. The significant increase in intersegment eliminations due to lower motion picture and television production revenues from licenses further highlights the impact of these factors on the company's financials. Overall, it is clear that changes in theatrical revenue, international revenue, home entertainment revenue, and television revenue are the primary drivers of Lionsgate's revenue growth or decline. Lionsgate Studios Corp. Market capitalization of $3 billion is materially smaller than most of its industry peers of roughly $33 billion. Lionsgate Studios Corp. Trades at a lower price-to-book ratio of -9.19 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 118% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. Net income and profit margins. A shift in performance. The net income of the company has experienced a significant increase in losses over the past year. In Q3 2025, the net loss increased by $24.3 million compared to Q3 2024, reaching -$46.2 million. This trend continued throughout the year, with a YTD net loss of $268.5 million in 2025, a $23.8 million increase from the previous year. The profit margins have also undergone a significant change. The operating income margin decreased from -95.6% in Q3 2024 to -20.5% in Q3 2025, indicating an improvement in profitability. However, this trend was not consistent throughout the year. The YTD operating income margin decreased from -10.6% in 2024 to -1.2% in 2025. The decrease in profit margins can be attributed to increased debt service obligations on variable rate indebtedness and interest rate risk exposure. This has had a significant impact on the company's financial performance, resulting in lower profitability. Despite this, the net income increase in Q3 2025 compared to an unknown quarter in 2024 suggests that there may be some positive trends emerging. The company's financial performance varied across different segments and regions. On a positive note, the international segment saw significant growth in revenue, increasing from $70.4 million to $120.6 million in Q3 and $291.1 million to $278.3 million in 9 months. The digital media segment also performed well, with revenue growth from $145.7 million to $155.1 million in Q3 and $400.3 million to $387.5 million in 9 months. In addition, the electronic sell-through and video-on-demand formats, as well as the distribution of television product, showed strong performance. The studio business segment profit also remained steady, with a 3-month profit of $114.2 million and a 9-month profit of $139.4 million. However, some segments struggled to keep pace. The theatrical segment saw a decline in revenue from $35 million to $70.7 million in Q3. The television production segment also experienced a significant drop in revenue, decreasing from $404.6 million to $303.1 million in Q3. Furthermore, the domestic theatrical product and international markets related to films initially released in prior periods performed poorly. The motion picture segment was particularly affected by decreases in television revenue, international revenue, and home entertainment revenue, resulting in a revenue decrease of $105.2 million. The television production segment also suffered from declines in domestic television and other revenue, with a total revenue decrease of $272.2 million. Management's outlook on the company's strategy is centered around releasing high-performing titles with a focus on marketing and distribution efforts. This approach aims to drive revenue growth through successful film releases. In terms of financial management, the company expects consistent cash requirements for productions in the short term, but believes it has adequate liquidity to meet operational needs. The acquisition of A&A Management Group, LLC, is seen as a strategic move to expand relationships in the sports and entertainment industry, with a distribution agreement for 46 films through CPLG Library Holdings. This deal is expected to provide key partnerships and increase revenue opportunities. Management also uses segment profit as a key performance metric to evaluate operating performance and make resource allocation decisions. In terms of revenue recognition, management expects to recognize revenue from performance obligations when content has been delivered and the exploitation window begins. Sales or usage-based royalties are subject to estimates of relative standalone selling prices. Overall, the company's strategy is focused on driving growth through successful film releases, strategic acquisitions, and effective financial management. The company has made several acquisitions to expand its business. These include acquiring libraries, film rights, and businesses that complement their existing operations. They have also invested in various ventures to further grow their portfolio. In terms of divestitures, the company does not appear to have any notable transactions listed. However, there is a mention of separating the studio business from the Starz business, which could be either a reorganization or a divestiture. Additionally, they may dispose of individual films or libraries as part of their business strategy. The company's financial strategy has been focused on rewarding shareholders through various means. One key aspect of this approach is the payment of dividends, which indicates that a portion of the company's profits are being distributed to its investors. This practice not only provides a regular income stream for shareholders, but also reflects the company's commitment to sharing its success with those who have invested in it. In addition to paying dividends, the company has also implemented a share buyback program. This strategy involves purchasing a portion of its outstanding shares from the market, which can help to increase earnings per share and boost investor confidence. By buying back shares, the company is essentially reducing the number of shares available for public trading, thereby increasing the value of each remaining share. Concerns about inventory buildup or supply chain disruption. The entertainment industry is facing several concerns regarding inventory buildup and supply chain disruption. One major concern is the significant increase in direct operating expenses, particularly in the motion picture segment, which rose by 47% on page 45. This could indicate potential issues with labor costs and profitability. Another area of concern is the decrease in television production revenue, which dropped by 25.6% on page 76. Additionally, distribution and marketing expenses increased significantly, rising by 96.4% to $140.2 million on page 71. These increases may suggest potential issues with supply chain efficiency, particularly in areas such as premium VOD expense. Industry strikes may also have contributed to lower demand and unutilized production facilities, as mentioned on page 64. This could further exacerbate concerns about inventory buildup and supply chain disruption. However, it's worth noting that some of these concerns are not directly related to inventory buildup or supply chain disruption, but rather to other aspects of the business, such as profitability and revenue decline. Overall, while there are several indicators of potential issues with inventory buildup and supply chain disruption, a more detailed analysis is needed to fully understand the extent of the problem. That concludes the financial summary for Lionsgate Studios Corp. Feel free to comment below, and I will be happy to answer them when possible.